Hey traders and investors, hey, Tyson Clayton here, Market Traders Institute. We are doing our Ask the Analyst series. We've been doing this for 3 weeks now. Hopefully everybody is doing well. Hopefully you're having an absolutely great week. 2 weeks ago we had Chris Pulver on. Last week we had Gary Thickhart on. This week you get me, Tyson Clayton. It's good to be here. We're going to do our Ask the Analyst. This is where you can post your questions. Ask anything you want for the next 20-30 minutes. We're going to go through some of my favorite trade setups. We're going to go through some of the ways that, based on my 19 years worth of trading, some of the things that I've done to experience success, some of the pitfalls, and again, ask any questions that you have. So I want to kick things off. I did get one question in the chat section, and I want to kick things off right away here. And make sure that we can answer this question. It was a question on the pound, and the question was, what do we think the pound is going to do? How do we think the pound is going to react? Is the pound going to retrace, the pound dollar going to retrace back to the 382? And I just want to pull up something here. I shared a chart. I'm going to actually share a couple charts that you guys can go into through SmartTrader when we're done with this session. But I've been sharing a lot of charts in 2020. One of the things that I'm going to continue to do is share a lot of charts in 2020. But what I did is I shared a couple workspaces that you can go back and look at. One is called Tysons 2020 buy-sell levels. We're going to go through that here in a minute. And then the Tysons 2020 index forecast. So I want to start on the pounds because the question was not necessarily specifically just in the pound, but the pound dollar. And the question from the student was, do I believe that the pound dollar is going to retrace back to the 382? And the answer is, well, yes, I do. We're going to go through that in a second here, but let's start with the pound index. The pound index is GBPX. And the reason I believe this is I believe a lot of the Brexit news and the idea of independence and all that was priced in with this big euphoric rise that happened from late August into the end of the year. And actually, we called this out really nicely. You can go back on webinars, and Chris Pulver, myself, Gary, all of us were talking about the pound rallying. And it rallied up right into this area of supply. We have a really big area of supply. And what it also did is it created this up AB. This up AB doesn't necessarily have a retracement, but then we have a confirmation. And that's also another thing I want to talk about in this session here today is what are the steps that traders need to take? Because I get this question a lot. What are the steps that traders need to take to actually earn the right? And I talk about this, earn the right to enter a trade. We can't just go into a chart and start to look for trades. We have to earn that right. So I want to talk about the steps that we need to take. But the idea on the pound is I'm bearish. I believe we're heading down. And overall, I believe in the pound index, we're going down to this 15,500 level. Now, you can't trade the pound index. So what does that mean individually? What does that mean for currency pairs? And so what I want to do is I'm going to go to this Tysons 2020 buy-sell levels. And I want to pull up, and I believe I have the pound dollar on here. I do. Here's the pound dollar. So this is my pound dollar trade, and I've been talking about this. Again, this is a chart that's been that was shared with everybody at the beginning of the year. In fact, January 2nd is when I shared this chart, and it had all of these trades on: pound dollar, CAD yen, pound yen, gold. I'll talk about gold a little bit today. Aussie, Swiss, all of these. But what I was looking at was this, and I was looking at sell levels. I expected the pound to fall based on the overall analysis that I did on the index, and the rally that it had, from what we talked about, that late August into the end of the year. And so it's been falling. It's been nice. And so I had my sell levels, and these sell levels were created, or I put them there based on what's called supply and demand. The market moves, always has, always will move between areas of supply and areas of demand. And if the market moves between areas of supply and demand, if we're sitting in an area where historically big sellers started to come into the market, then chances are there's going to be multiple sellers or big sellers at that level again. And the theory behind it is this. Let's say I was a big seller. Let's say I was a massive institutional seller, and I started to sell the pound right here. And I had a big client that came to me and said, Tyson, I need you to start selling pounds. And let's say I was a money center or a money manager, and I need you to start selling the pound. And I want you to get me short the pound or sell the pound between 132 and 150, let's say. Well, if I start selling right here, the market's going to move aggressively. If I have, let's say, billions of dollars that I'm managing, the market's going to start to move, and it's going to start to accelerate to the downside, and it's going to get beyond my mandated sell level, right, if I'm an institutional trader. And so then I have a choice. So let's say I was trying to sell, let's just use fake numbers here. I was trying to sell $500 million worth of pound right here. And I ended up getting filled on 300 million of it. But now price is down here. Well, I have a choice. I can call my client up and I can be like, hey, here's the deal. I ended up taking the trade like you told me to take the trade, and that's great. But I only got filled in 300 million of the pound dollar short. So I've still got 200 million to fill. So I have a choice. I can fill the trade. Right now the price is sitting at 130. I can fill it at 130, but I'm not going to be able to get the price you wanted. That's 150 pips. Now think about this. What that client, and again, this happens. These conversations happen with banks. Think about like a company like Coca-Cola. Calling Goldman Sachs and saying, hey, we need to hedge some of our risks, some of our pound dollar risks, so I need you to do this. And so now I'm talking to, let's say, Coca-Cola or some big client, and I'm like, hey, I can fill that other 200 million worth of pound dollar that you wanted to sell, but I can only fill it at 150 pips worse than what you wanted me to fill it at. So we're talking a trade. If I fill that at 150 pips worse on $200 million position, let's do the math on this. I just want you guys to understand this. On a $250 million or $200 million position, that's 2,000 contracts. That's $10 per pip. So we're talking about every pip is worth about $20,000. So if I go to that client and I say, hey, I can fill you 150 pips worse than you wanted me to fill you, that's a $3 million loss that company's going to have. What they're going to tell me is they're going to say, Tyson, here's the deal. We told you to fill us between 32 and 31.50, so you better do your job. And so I'm going to have to sit on my trade, and I'm going to have to find a way to fill them at right around that 32 to 31.50 level. So what I'll do is I'll sit there and I'll wait for prices to go back up into that supply level, and then that's where I'll start to. So that's the theory and the concept for supply and demand. And so what I was looking at is I was looking at these levels to start the year as areas where price is likely going to go into and then start to sell off from. And that's exactly what's happened in the pound dollar here. To start the year, we rallied up into this level here, right in here. In fact, I think we got up to the second level too. Let me see here, high 32.82. Yeah, check this out. So the beginning of the year, I posted this on January 2nd. So we rallied up to this first level, rallied up to the second level within 2 pips, and then price ended up falling aggressively by about 400 pips from there. But we're not done yet. This trade, I'm very confident this trade is absolutely going down. My buy levels that I'll start to look to buy at is right around 127 and this 125 level. So to answer the question, do I believe we're going down to the 382? The answer is absolutely yes. I believe we are going to 127. I actually think that we're not going to stop falling until about 125, but I will take a shot at this 127 level. So that is a yes. Now, I did share another trade, and I want to kind of show you this trade here, and I just shared this right before we started this session. And so one thing that I want to show you guys, and I want to make sure that you're taking advantage of, is in SmartTrader, please start to use the Ideas tab. And so the Ideas tab, so if I go up here and I go to Ideas, or I go to smarttrader.com and I go to the Ideas tab, there's a wealth of knowledge sitting in here. In fact, if I could go back 19 years and have access to something like this, my trading, I wouldn't have struggled like I did for 3.5 years. I was, I think, the world's worst trader for 3.5 years. I was horrible at trading, and I lost a bunch of money. But if I had access to something like this, where professionals could kind of show me the setups that they're looking at and share their trades and ideas with me, it would have been awesome. So that's what we do here. So I shared this trade. It's the pound yen. I call it pound yen swing short. I've been talking about this trade for a while, and I just updated it. So you can go to the ideas tab and check it out there and look at this. But I want to kind of go into this. So the way that you download this into your charts is you click this little download tab right here. And I'm going to click that. I'm going to bring this into my charts. And I want to kind of take a step back, and I want to talk about this trade and how this is a trade that meets all my requirements for me to finally say, okay, now I've earned the right. And in fact, I would recommend you guys writing down that statement. Earn the right to look to enter. Too many traders go out there, and psychologically this makes sense. Too many traders go out there and they go into a chart and they're like, man, I got to start trading, right? Because a trader needs to trade. If we're not trading, if we're not in a trade, we don't feel like we're being productive. And I used to get caught in this cycle also. And so my mentor told me, he said, Tyson, your problem is you always want to be in a trade, you're hyperactive, you tinker with your trades. And so what you need to force yourself to do is force yourself to go through steps and earn the right. Ask yourself specific questions first before you actually place a trade, or before you even look to place a trade. And so those questions are this. And so I want you to think about these questions as I go through this trade. The first question that we must ask ourselves before we place any trade, and I talk about this a lot in webinars, but it's so important for me to repeat here. The first question is this: what direction? Right? I cannot come up with any type of plan or a quality trade if I don't have a clear, concise, systematic way to define a direction. I know some traders that are able to kind of go into a chart and not have a clear direction and be able to, scalp trade and, kind of anywhere the market's going to go. I call them flap in the wind type of traders. I'm not that trader. I'm a trader that needs a very clear, concise direction to be able to trade in. So I always ask myself, well, what is the next direction that the market's most likely going to move in, right? Where's probability telling us that direction is most likely going to move? And so I use Fibonacci's with this one, and I can see that we have this up AB right here, and we don't have a 382 retracement. And so in the Ultimate Traders Package, you guys know that we talk about something called the 80-20 rule. So the 80-20 rule states every AB sequence has an 80% probability of going to a 382 retracement before going to an extension. So that's a kind of a fancy way of saying this. This probability right now states price is going to come down here before it goes up here. And there's an 80% probability based on historical patterns and historical Fibonacci. So if I know that, what that does for me is it automatically gives me an edge. Doesn't mean this trade's going to work out for sure, but it gives me an edge in the market. It says, you know what, hey, I know I need to start selling at least down to that 382. So that's one. Number two, and we've kind of already answered this question because the Fibonacci's help us with this. Number two, we need to say where to. So I can't just come into the market and say, hey, we're going to sell off, right? Some of you guys have heard me tell this story before, but the reason I can't say, hey, we're just going to sell off is because in 2011, I used to have a radio show in the Twin Cities, and I was on the radio show, and I was talking about how bearish I was in the stock market, and I traded a lot of stocks in my past also. And I was like, man, I'm so bearish, and the market's going to move down. And in the market, this was in late summer of 2011, September, October 2011. And I was super bearish, and the market started to move down aggressively, late September into October. And so the trade paid off amazing. But here's the problem. I didn't have a target. So I ended up having a bunch of profits in the trade, but I never locked in profits. I was basically kind of perma-bearish, almost like a permanent bear, and I didn't have a target, and I watched the market bottom, reverse, and I gave back a huge amount of my profits. And so when that happened, I basically told myself, listen, it's very frustrating to be right, but not end up paying yourself like you should pay yourself because you didn't have a clear-cut plan. So from that point, I basically always come up with I can't just say, hey, we're moving down. I got to say, we're moving down to this level, right? So for me, in this trade, we're moving down at least to the 382. But actually, I'm confident we're going to get down to 131.81. And we'll kind of go through that. So what direction, where to? And then the third thing we need to ask is, where am I wrong? Yes, everyone, yes. We're going to be wrong. But this is the type of trade where we shouldn't be afraid to be wrong. What we should be afraid of, we shouldn't be afraid of anything, but what we should be concerned about is our ability to continue to push the button in the right direction, right? So, give an example. So, I believe I am wrong on this trade at this time if price breaks above 44.65. That's going to be my stop. But, because we're going to lose every once in a while. And this trade might lose. But I want you to think about this. And this is something really important. This business should be fairly easy for us to make money. Again, as long as we're disciplined enough to continue to push the button in the right direction, in the direction that we know probability is most likely going to move in. Think about this trade. We're looking to make, if I just started to sell, if everything lined up and this trade plays out, and let's say I sell, I'm looking to make about 1,200 pips. Let me do the math on this. I'm looking to make about 1,200 pips, and I'm risking, what am I risking? 65, 70 pips? So if I take 1,200 divided by 65, I've got a trade that's given me 18 times reward in comparison to risk. Now, there's a few issues with this trade because it's very difficult for a trader just to short and to hold this all the way down here. But the fact is, this trade on the surface offers an 18 times reward in comparison to risk. So then what I got to do is I got to basically ask myself, am I convinced that this trade is going to win 1 time out of 10? And if I am, then I need to, as a professional trader, I need to push the button because it's a money-making trade. Think about this. You take this trade 10 times. Let's say you risk $1, right? Risk $1. Take this trade 10 times. I win only once. I lose 9 times. Well, I win $18.46 that one time that I win, and I lose $9 on my losses. I'm still up net $9.46. So again, I'm not in this business to only win 1 out of 10 times. Nobody wants to win 1 out of 10 times, but I show you an example like this because an example like this should really hit home and say, man, you know what? You're right. If we can get the proper reward versus risk in our favor, then we should be able to make money. Now, the next question is, well, Tyson, but what if you get stopped out in this trade? What's next? Well, what's next is my directional bias is still to the downside, but what I'm going to do is this. If we break above this stop level, then we have another level of supply sitting right up here. So what I'm going to do is if we break above this level, I'm going to save myself about 100 pips. Now, I could, if I wanted to, I could say, you know what, instead of me trying to, take a stop here, I could move my stop above this A right here and short now and then short up here also. But instead of doing that, if I'm a professional and I know what I'm doing, I'd rather save myself the 100 pips if I can. So what I'm going to do is there's a rule that I'm going to have for me to sell. If I get stopped out, I'll short again a little bit higher, but I'll help you guys keep kind of up to date on what's going on with this trade. But those are the questions that we need to ask before we earn the right to even look for an entry. What direction? Logically, clearly, systematically, using Fibonacci's, using strategies. You can use a right trader, turning point, 6-figure max, whatever it might be, but have a systematic way to define a direction. And then say, okay, great, we're moving in this direction. Where are we moving to? Where's my target? Okay, once I understand where we're moving to, then I can say, where am I wrong? And then I can figure out, okay, now how do I get into this trade? Because then there's a million different ways to get in. I can throw on an automated strategy. I could trade this manually and trade all trend line breaks down. There's a lot of stuff I can do. But once I've done those 3 things, once I've answered those 3 questions, now I can start to look for an entry technique. And the ways that I like to enter is I like trend line breaks. I like breaks of supply and demand levels. One of my favorite things to do, and I've always been a big fan of this, is kind of goes back to what I said earlier, which is I tend to tinker with my trades, right? Just give me a second here. I tend to tinker with my trades. And so the way that I stop tinkering with my trades is, why not utilize technology? Why not utilize some automation? Like, for example, this is a perfect example of a trade that I'm the developer and the creator of Turning Point. Turning Point's probably my favorite strategy that I've ever traded and favorite strategy that I've ever created. And so if I believe that we're heading down to this level, then why not just turn on Turning Point, sell only, and just let the strategy take me in, get me out, manage the trade, and just continue to, as long as we stay below this 44.65 level and until we hit 31.81, why not just turn it on, sell only? And so that's probably going to be my plan. But on a manual level, what I said, and I said this in a webinar earlier, I said, because today's bar, now I know I'm going a little technical here, but because today's bar is it's a pretty aggressive bullish bar, I don't want to get in front of that bar. I don't want to short in the face of a bullish bar like that. So what I'm going to do is, if today's bar can sell off and close below its halfway point, then I will look to sell. That's the reason why I typed it out the way I did. I said price is currently in my sell zone, so I am willing to sell right now. But before I want to really start to jump in aggressively on this, let's look to sell if price closes below Thursday's or below 144.08, which is the halfway point of the high and the low. And so that's a trade that I really, really like. On top of, this kind of ties in to what we started talking about, which is my forecast on the pound, which is a bearish forecast, at least for a little bit longer. So hopefully that answers your question. Again, I've shared this workspace with everybody. It is in SmartTrader. It's listed as the pound yen swing short. You can pick it up in the ideas tab. So let me look at the questions we have streaming through here. Another question is, why are the market's average true range going low year by year, less volatility? That's a great question. So the reason being is because of the advances of technology, because of the lower barrier of entry for individuals to get involved. So there's a lot more volume and a lot more retail traders involved in the markets today than there were last year or the year before, 10 years ago, 15 years ago. And because of that, there's more liquidity, and more liquidity means that prices are going to move in tighter ranges. And so I believe that we're going to get shocks in the system, big moves in the system, in currencies and in stocks and all that kind of stuff. Again, those are going to happen. But I think that we are in a world where we can expect lower levels of volatility for longer periods of time than we ever have historically. And it took me a while to adopt to that, because I'm a big fan of watching the volatility index. And back 10 years ago, the volatility index the average of the volatility index was about 18 to 20, which means that, not to get technical on you, but what that means is the S&P 500 would typically move in a peak to valley kind of range of about 18 to 20% on an annual basis. Now, I think we're living in a world where I think the volatility index is going to spike. I think it could spike up to 35, 40, 45 again eventually someday in the future. But I think long-term historical averages are no longer going to be 18 to 20 because of the technology and the liquidity and the quick movements that happen in the market. I believe that the volatility is going to be more like 12 to 14, which means we may need to shorten our time. So what does that mean for you as a trader? It means that we need to shorten our time horizon on what we try to capture. Like, this is a perfect example of a trade. This is a trade 10 years ago that I could get in, and this trade might only take, 2 or 3 weeks to get down to this level because the volatility was so big. Now, because volatility is tighter, we go into these tight range scenarios. This trade might take 2-3 months to get down here. And that's part of the issue. That's actually one of the things we're talking about a lot in our client webinars right now, is how do traders become more active? If we know we're heading down here, how do we maximize the time that we spend shorting? Instead of just shorting one time and holding for 3 months down here, is there ways that we could potentially short and continue to short and ride all the waves, all the little micro moves that are going to potentially happen all the way down? And the answer is yes. So what it's requiring traders like me to do is either one of two things. Either be way more patient, which is tough, even tough for me, but really tough for newer traders, or I have to have a long-term plan like this, but then use shorter-term strategies to be able to execute and kind of take those small little chunks as I'm giving them within the market. So hopefully that makes sense. So I think the answer is because of technology, and I think low volatility is here to stay. However, we will see spikes in volatility. So we'll be. There's only one thing I know for sure. Low volatility, tight range markets are followed by expansions 100% of the time. But I think what's going to happen is it's going to take longer for those expansions. We're going to be tight, low volatility for longer than we're used to, and then the expansions could potentially be even more aggressive than we're used to also. So when we get those expansions of volatility, those that understand what they're doing, it's going to provide awesome opportunities for us, but it's going to catch a lot of people off guard, and it's going to hurt a lot of people that don't know what they're doing, if that makes sense. Let's hear. I got another question here. Do you think Forex trading has added value when there's fears of recession? I think yes, and for the exact reason why I just said. When fear comes into the market, we start to get increases in volatility, and that's a good thing. So most individual traders or individual investors that go to a 9-to-5 job, normal 9-to-5 job, volatility or big massive movements isn't necessarily good for them because it's too much. But for traders, we need movement. For me to make money, for me to make any money by price going down here, I need price to move. It's got to go down there. And yeah, I don't want it to take 2 or 3 months. It could, but the more fear in the market and the more uncertainty in the market, I hate to say it, but it's actually a good thing for traders because it allows for those bigger moves. It allows for more volatility in the markets, and more movement should ultimately equal more profit potential for you and I. That's the big thing. And so, yes, I do think that fears of recession will help traders make more money. Now, however, saying that, I do fully expect, and I want to be very clear on this. I fully expect. In fact, I think that there's I don't know. I'm just going to put some hypothetical probability on it. This is Tyson's opinion, okay? From my opinion, I believe there's about a 98% probability of us going into a true bear market, which is a 20% sell-off in the stock market within the next 2 to 3 years. Now, here's the deal. I said that 2 years ago. So, the timing, who knows when it's going to happen. We've obviously proven we can kick the can down the road for a long time. However, here's the thing that people don't understand. Most people, and this is where some traders, even very knowledgeable people, kind of get thrown off. Most people say, man, we're going to go into this recession, and that means the dollar is going to get absolutely killed. Well, no, actually, it doesn't. And the reason being, if you go back and you look at how the dollar performed in the dot-com bubble, right, in 2001, 2002, if you look at how the dollar performed in 2007, late 2007, 8, and 9, it rallied. It actually got stronger. And the reason why is very logical. Although money centers around the Fed officials around the world can create money, right? They can turn on the printing presses and they can create money out of thin air, but you and I can't. And when we sell something, if I own stocks, if I own $10,000 worth of Apple stock, and I'm like, man, the market's going to fall, I need to sell my Apple stock because the Apple's going to get hurt by the coronavirus, and it's going to get hurt by exports and imports and all this kind of stuff, and consumers going to tighten their belts. And I start to sell my Apple stock. We got to always think, what am I selling my Apple stock for? Money is circular, right? It doesn't just, I don't sell my Apple stock and then the money just disappears. No, I sell my Apple stock to raise what? Most of the time I sell my stock to raise dollars. And so what happens in a recession is people get fearful and they sell their risk assets. They sell their stocks and their real estates, even commodity, and they raise dollars. So it puts a natural bid under the US dollar. So I know that some analysts have been talking about how being like super bearish the dollar. I'm not that analyst that is super bearish the dollar. Do I think the dollar will be bearish eventually someday? Yeah, I do. I just do not think that selling the dollar in the face of a potential upcoming recession. Now, when is that going to happen? I don't know. A year, 2 months, 5 years, I don't know. But I would not be selling the dollar in the face of a U.S. recession. I just wouldn't be doing that. And I think there's technicals that show that that there isn't reason yet, in my opinion, to be selling the dollar aggressively at this point. But yeah, I mean, we'll talk more about that in the client webinars. Let's see here. We are going to. We've already gone in half an hour. I can't believe I already talked to half an hour. Have I already talked to half an hour? Unbelievable. Time flies when you're having fun, right? So I'm going to wrap with this, guys. I can't believe I've already went a half an hour, but this has been absolutely fun. I talked about 10% of what I wanted to talk about, but we're going to continue to do these sessions. The next thing that I want to talk about is when I'm on one of these sessions is the theory of buying low and selling high, but then defining what does that mean? What does it mean to buy low and sell high? We have to have definitions of what a low price is and how we actually execute and how we get in. What does a high price mean and all that? I want to talk more about that, but I am going to share this workspace. I already did. It's called the Pound Yen Swing Short. Also, if you want to go and look at my 2020 forecast, I have a workspace that's called Tyson's 2020 buy-sell levels that has some of my favorite trades on. Some of these are already doing really, really well. Some of them are in their buy zones, sell zones right now. This is kind of a blueprint of what you can follow along with. And on that, guys, ask questions, come into the webinars, get involved. We're here to help. We're here to try to, traders helping traders, and want to get you guys to a point. I say this all the time. I want to help you guys get to a point of financial freedom where you don't need me or anybody else ever again someday. That's the whole goal. Okay? All right, everybody. Have a great day. We'll talk to you soon. Thanks.